You're watching What's Hot on CNBC TV 18 at a time when India Inc. is facing challenges to raise funds and repay debt. FICCI and Ernst Young have come out with a report with suggestions to raise long-term capital. And on What's Hot tonight, we ask, how can companies tap funds in these tough times? To answer that, Ashwin Parekh of Ernst Young is now joining us. Mr. Parekh, many thanks for joining us. This report that you're talking about specifically talks about exchangeable bonds, NCDs with warrants and so on. But in times like these, will there be any takers?
See, basically the play between the investors and the issuers, in the market particularly, is going to be full of new challenges. But at the end of it, some of the instruments that we put out in the report, for instance, are in keeping with those challenges to begin with. Some of these are, by concept, the instruments which perhaps the Indian markets have used in the past, or some of the other markets have been using now. Now what may happen is we've suddenly moved from a very liquid market into a very illiquid market on one side. We've seen a situation where the value, let's say, sitting in these instruments have suddenly shown a huge volatility. Look at, let's say, either the domestic convertible bonds, for instance. 10 years ago, it was a very popular instrument. Today, for instance, in the last 5 years, we haven't seen much play, with an exception of one that happened very recently, the Tata issue, basically, but which is really an interesting one, once again, reassuring us that there is a market for such instrument that we are talking about in our report. What is now critical, perhaps, basically is higher order of transparency, and that's something in the report we are talking about that, or a higher order of communication, relevant communication to the investors on a regular scale on the performance of these instruments. So that's something that is being addressed to. We are very convinced that with proper modification, some of the instruments that we've referred to in the report will certainly take off, will certainly be used by the investors.
Right, Ashwin, this point about the corporate debt market not being deep enough has been made many times in the past. In fact, the recent RBI report on the assessment of the financial markets pretty much talks about exactly the same thing. What specific measures do you actually expect from the government, or for that matter from the Reserve Bank or the regulator?
Yeah, now, see, basically what may happen is sometimes, whenever an issuer, floats an instrument or a paper in the market, he will normally address the risks which are known or risks which are uppermost in his mind, and he'll put them out. Now, sometimes it may so happen that the risks which the investors ought to know a little more in greater detail. For instance, we will agree with me that in the last 6 months, when the markets went very liquid, say an instrument like FCCB, for example, suddenly faced a new set of challenges. The investors did not even dream for a minute, about two situations. One is that there would be a substantial amount of external commercial borrowing kind of an environment, which Indian, let's say, corporate issuers will have to face. And on the other, the value multiples will shrink like the way they have, So, but let's say for the bond markets, and when we look at the bond markets in particular, we have to bear in mind, that each time a new instrument is floated, the disclosure around that becomes very critical, the governance around that becomes very critical. Let's take a simple example like FMP products. Mutual funds introduced them. This was one sure way of bringing retail debt, in some form, to the extent that at the back of the buyers, let's say the investors for FMP, to the extent they were retail, leaving aside some of the corporate surplus guys who had institutional surplus and who parked in the FMP products. But the others, the retail, what they ended up picking up was debt paper, at the back of it. However, look at the transparency in the entire system. Look at the amount of disclosure that happened. The regulator at that point in time did not, foresee the kind of risks which was setting into the FMP kind of products, the assets behind the underlying assets. There was a requirement to disclose that. But in reality, only after the value, in some of the paper that was, or the rating of some of the issuers changed dramatically, that the whole question about the transparency and the underlying assets came up, Now, then the regulator started addressing those, So that's the whole point. When an instrument is created in the market, when we talk about transparency, we really refer to all the aspects, including the stress aspects.
So you're saying that